Will tariffs cause oil prices to tumble? Let's talk about it this week in oil. Hi, I'm Aaron of the Oil Balance. With 30 years of experience in oil trading and analytics, I'm here to elevate your understanding of the oil market. So, in this week's video, we're going to talk about a lot of the things going on in the market, about the tariffs, about Iranian flows possibly being stopped, all sorts of fun stuff. But you'll be happy to know that this week we released this report. This is our in-depth report gaming out certain tariff scenarios. So if you're interested in the topic of this video, you need to get this report. This will tell you in long form, working out for the balance of the year, what will happen under the scenarios that we lay out. All right, we're going to start out with some price charts this week. So we've actually had a little bit of recovery in WTI futures prices and crude oil prices. Here's the big sell-off from the week that President Trump announced all the tariffs going into effect. The market spiked all the way down to $55. Since then, this week, the high this week, we've gotten up to $64. So we've got about a $9.75 range from this very bottom low that we put in about 2 weeks ago. So the market is trying to recover. It is trying to sort of rebalance. The interesting thing, as I've pointed out before, is the price we're at. So we're sort of $63, $63.25. Again, that's a difficult price for everyone to sort of deal with for this reason. It's probably too low to keep crude producers, at least shale guys, plowing a lot of money into the space, right? Making a lot of big investments, going out, getting new leases, putting new holes in the ground, that sort of thing. It's a good price for them to keep things going. It's a good price for them to sort of maintain production. And we're not in the 50s, or worse yet, the low 50s, where they would actually be talking about reducing production, right? Taking production down. So we're kind of in this little bit of a limbo range right now in terms of crude production. We need to be maybe $10 higher to really ensure ongoing growth in the oil sector, at least in the crude oil side of things. I don't know if we can get back there just yet or not. We'll keep talking about that as this presentation goes on. But just know that it's in a very interesting price point right now to the market. It's kind of on pause, kind of walking on eggshells a little bit, saying what's going to happen with all this stuff. In terms of the refined product, though, we're actually seeing a decent bounce back in price on both gasoline, which is RBOB is a gasoline blend stock. Those are the futures you can trade on the NYMEX. I've got this chart here set up as the crack, so it's RBOB versus WTI. This is what the refiner might capture, or at least theoretically looking at just the futures markets. But we're back up here to sort of $25, so you can see, and this is a daily chart, but you can see we've made pretty good progress since sort of the middle of the month after the big sell-off. We've made a lot of progress bouncing most of the way back from where we were before the April 2nd announcements came through. But again, remember that WTI price is now at a lower rate, which means your pump prices are going to be down. I'll show you that chart here in a minute. On the diesel crack, it's set up the same way. New York Harbor diesel versus WTI futures, again, sort of synthesizing what the refiner might see. Similar sort of area in terms of price. They're pricing pretty close here to each other. But again, we've made a decent recovery in the last few weeks. We've had some interesting inventory stats come out, especially on the diesel side where things are looking a little tighter now than they had been. But let's get into the headlines here real quick. All right. So again, in terms of the tariffs, things seem to be cooling off maybe a little bit. In terms of the China-US tariffs, it sounds like Xi Jinping and President Trump are actually talking now, or had at least had one conversation. So that's going well. China said they may exempt ethane from retaliatory tariffs. Again, if you get our big report that I mentioned at the very beginning of this video, I go through that quite a bit, why that's so important. And then President Trump thinks we're 3 or 4 weeks away from getting these trade deals done. So we still have some time, some uncertainty to go through, and probably a lot of headlines back and forth that'll make the market a little nervous, both the oil markets and the stock markets as well. In terms of OPEC, remember they're trying to bring back production. It's a little confusing because they have some of the member states actually had been ramping up production sort of ahead of time, if you will, and now they're trying to claw back some of that production. So it looks like maybe some of the early stages of their so-called production increase might actually result in lower month-on-month composite production numbers, if you will, across all of OPEC Plus, as people try to step back and rein in the overproduction they had before. That being said, Kazakhstan seems like it's in a tough spot right now where they're not really able to bring back down production. At least that's the way I'm reading it. Maybe I'm reading that a little bit wrong or putting it in too good of a light for Kazakhstan. Maybe they'll break away from the OPEC Plus. We'll see. And again, keep in mind that that's typically how these OPEC deals fall apart, is that various member states just start doing their own thing. And it's more than what sort of the core OPEC or what Saudi can sort of hold on to. And then everyone starts producing and becomes a real mess. So that could actually be the method, the mode for tanking the oil market. Is OPEC falling apart? Is the OPEC deal falling apart and everyone putting way too many barrels back in the market? I'm going to have another video on OPEC itself here in a couple days, so please stay tuned for that. Again, some members, getting back to the headlines here, some of the members of OPEC are already lobbying for another production increase in June, so we'll see how that goes. Again, from a balance standpoint, I don't see how that works. There just doesn't seem to be the demand there. Maybe they're seeing something I'm not. From an oil perspective, it seems like Russia, Ukraine has really fallen by the wayside. Obviously, from a military standpoint and a human value standpoint, there's a lot of things still going on. But it seems like the oil markets maybe turned away from that conflict a little bit for the time being. That being said, Russia is ramping up production. And one of the reasons the market is speculating that is because they think that the sanctions will start to come off once there is peace in Ukraine. So maybe Putin is sort of seeing through the near-term conflict into a fairly nearby time period where there's peace in the Ukraine and things start to get back to normal, at least in terms of oil flows between Russia and Europe and Russia and the rest of the world. Again, we'll have to sort of wait and see what happens there. Iranian tensions, though, are still pretty high. The U.S. administration is still saying they want Iranian exports at zero, Iranian oil exports at zero. Their key buyers are mostly China, mostly Asia, and then China is probably the biggest number one sector in there. And this is causing because their buyers, their normal buyers, are really shying away from taking any more cargoes. This is causing their floating storage to increase. Kepler says we're at an 18-month high in floating storage, somewhere around the 40 million barrel mark floating in the Persian Gulf. So the good news is if things turn around one way or another and Iran is able to sell those barrels back into the market, the good news, the silver lining is they're already on boats. They're already ready to go. So it's a pretty quick relief once that signal is given. I just don't see that signal being given anytime in the near future. And then the vessels that had been carrying Iranian crude, even if they're not now, are still sort of frowned upon in the market, causing some tightness in the vessel freight market. And then in other news, Iran and Russia signed some economic agreements where it seems like Russia's really got to reach out and help Iran to sort of step up. They're going to send a lot of natural gas to Iran. The article I read was saying it's sort of similar to Nord Stream 1 type volumes. So remember that pipeline was blown up. Russia still needs to find a home for that natural gas to go. And it sounds like they found that home in Iran. It's just a matter of time to get everything in place and get those volumes ramped up. In addition, Russia will help Iran develop 7 oil fields. Again, are they maybe seeing through further into the future where there's more peace and harmony between the US and Iran and the US and Russia, where Iran could be exporting more? I don't know, but it seems a little silly for me right now for Iran to think about ramping up oil production, but this is a fairly long-term project, right? It might be a couple of years before these barrels see the light of day. So sort of keep that in mind, but it definitely seems like Russia and Iran are ramping up both in terms of their demand and in terms of trying to have product to export once sanctions are lifted on both countries, which again, I would say for the immediate time being is probably a bearish event. If those barrels were to come to market in the next 3 months, which would be highly unlikely, I don't see a place for them to go just yet. All right, so just to mention some of the key stats we had this week, we have jet demand really for the last 3 weeks been very strong, near record high demand numbers these past 2 weeks, just below the record high. Again, if you get this report that I mentioned at the beginning of the video, there's a whole section in here on jet fuel and what we think it's going to do for the rest of the year. This is right along this makes sense given the report that we've written here over this past month. That seems to be in line. Pad 5 refined products is a little bit exciting right now. We're well below the 5-year range. Valero said they're going to close one of their big refineries in the Bay Area at the end of the year. That's going to be another blow. I mean, that I could do a whole different video on that. But just keep in mind for right now, stocks are very low in Pad 5 for this time of year. And even you could probably say we're getting to 5-year lows. We're 5 to 10 million barrels away from 5-year lows. In a time period where we should be fairly well, we should have fairly sufficient inventory for the rest of the year. So things are looking a little bit sketchy right now in Pad 5 in terms of inventory. But again, the longer these tariffs roll on, the fewer vessels you're going to have making deliveries in places like the Port of Long Beach, and that is going to really reduce diesel fuel demand, which is you're probably going to have this knock-on effect there. Where these barrels could start to recover. So in a sense, maybe the tariffs actually help bail California, it's mainly California, but all of Pad 5 out of these really low inventories that they've got, especially on the diesel fuel front. In the Midwest and the Gulf Coast, Pads 2 and 3 runs are really setting up. So refinery activity is actually pretty high right now and should be ramping up in the next few months. I think week on week for next week, looking at a pretty similar refinery demand number, but then after that, we should continue to ramp up, sort of similar to last year, which last year we set our highs in the May, early June time period. That seems reasonable at this point for us to sort of repeat that. On the gasoline side of things, we had a really good demand number this week and a kind of poor demand number the previous week. Therefore, I took a 4-week average and threw it in the mix to see how things look. So really, we've had some pretty bad demand numbers here lately on gasoline. Hopefully you guys can see that on your screen. The one good demand number this week when taken together with a 4-week average is still pretty poor, still sort of below 2021 numbers. So again, that's a bit of a headwind. That's a little bit surprising. We are seeing pump prices fall, and that should help the demand to sort of recover. But just keep in mind that we've done some damage, at least on the 4-week average here, over the past month or so with these gasoline demand numbers. Some more interesting stats from the past couple of weeks here. Gasoline stocks have actually dropped really low. So again, we had a big increase in demand. The demand on these weekly numbers are backed into, they're calculated. So they take this change in inventory and they know what the supply was from refiners and from importers, and then they can figure out what that demand number had to be or the disappearance number had to be. So this big drop in inventory is why that demand number looks so big. Again, this number might not be correct. We'll see. and inventories maybe bounce up a little bit next week. But it does look like a huge drop. All of a sudden, we're very close to year ago type levels after spending much of March and April above year ago type levels. Diesel fuel, total US, we've been flirting with the bottom of the 5-year range mostly all year, sort of since February. And again, we're just below the bottom of the 5-year range here. So things are tight. Like I said a minute ago, the tariffs could actually have a good impact on distillate inventories if the distillate demand goes away for a short amount of time because there's fewer things coming into the ports, and that allows inventory to sort of recover. That's a good thing. If that goes on for more than a week or two, that's probably a really bad thing for the overall economy, right? But just a week or two would give us time to maybe get back up to year ago type levels or something like that. So I think you have to think of this thing. You have to sort of imagine different durations for how long this tariff strife could go on and these sort of reactions and whatnot. But that's something we'll be watching very closely. And then, as I just showed you with the jet fuel demand that we've seen here in the past few weeks, inventories have actually gotten back inside the 5-year range to sort of more normal type numbers after being well above. As we ramp up refinery throughput, as you saw a minute ago, I think we kind of bounce back to the top of the 5-year range, and that's fine. That's not a bad place to be. So it's probably good for commercial airlines, right? As fuel prices go lower, hopefully that sort of trickles through to lower seat prices as people try to fly around this summer. Let's flip over to the NGL side of things, where we're seeing some interesting data this week. In terms of propane, this is what I would say people typically watch. In terms of NGLs, if they're not super into that into the market, propane is probably a decent gauge. But this time it would actually lead you a bit astray. If you're looking at everything but propane, we're actually quite a bit above the 5-year range. That's a little bit concerning as to what this is that's building up so fast. So again, there's a lot of export capacity being built for NGLs right now. There's a lot of end user demand being built over in China. And it sounds like, as we mentioned a second ago in the headlines, that China is going to make carve outs for things like ethane to come into China without those reciprocal tariffs on them, which is really good, which might be part of this increase. We'll see. But it sounds like exports of ethane is actually ticking along just fine. It didn't really get too bad of a backlog there. So we've got this build in NGLs and LPGs that aren't propane, right? Because propane stocks are actually underperforming versus where they did last year. We're in the middle of the 5-year range. It's probably nothing to get too worked up about right now, but it's these other stocks of other NGLs besides propane that are increasing pretty quickly. One reason that's really important too is if you look at this chart here, this is from the International Energy Agency, looking at sort of comparing transportation fuels versus petchem demand. The transportation fuels of refined product are in this dark green color. NGLs are in this light color. What I'm trying to show is maybe you can see that for the past 2 years, the demand on the transportation fuel has been right around 80 million barrels per day. Again, this is a global number. It's forecast for 2025 to be just above 80 million barrels per day. Back in 2019, it was just above 80 million barrels per day. So if you sort of take out these COVID lockdown years, the Russia-Ukraine years, and maybe the COVID recovery year of 2021, where we had a lot of different signals going on in the market, making things a little bit crazy, you take those out and sort of look back to 2019 to 2023, 2024, you can see that the transportation fuel growth has been almost non-existent. Actually, from 2024 back to 2019, we saw a growth of only 230,000 barrels per day, so 0.23 million barrels per day. During that same time, this NGL plus naphtha category, so call it petchem or going into plastics and other things like that, that category has actually increased by 2.6 million barrels per day, so almost 10 times bigger than the increase in transportation fuel. So that's why these are a big deal. That's why the China allowing ethane exports from the U.S. to hit China without those tariffs is a really big deal, because there's a lot of money, especially in China, also in the U.S. too, but there's been a lot of money invested on steam cracking, the process you need to turn this into plastics, both in China and in the U.S. So so that's pretty significant, and we need to keep a close eye on this section of the oil balance. The propane futures have had some pretty big swings as well, as you can hopefully see on this chart. Much lower volume in the propane market, so you can have these huge swings as just a few trades move the market around pretty easily. So here's the big drop that we had the week that the tariffs were announced. This is about $7.50, or sorry, 7.5 cents. This is priced in cents per gallon. So this drop here is about 7.5 cents. What's interesting is back here in April of 2024, we actually at the end of April had a drop of just over 10 cents. So these big April moves are not necessarily unprecedented. Maybe what's a little more exciting is this bounce back that we've gotten so far. So the market absolutely panicked when the tariffs were announced, just like in all the other markets, oil markets we looked at. And since has made a pretty decent recovery. We're almost halfway back to that candle for that first week of April. Here's the retail prices. So gasoline is actually down about 10 cents per gallon from the highs we had just before the announcement. I'm expecting another pretty decent leg lower. We'll see what it actually comes out to, but another decent leg lower on next week's update. And you can see we're pretty far away now from year ago and from 2023 type numbers. So that's obviously a good thing for gasoline consumers. And diesel, we're doing a similar thing as well, where it's been kind of grinding lower for the past 2 weeks. Not quite as big as the move in gasoline, but a pretty decent move nonetheless. So again, that's ultimately good for the consumer. Does that carry on? Can that move forward? Again, I would invite you to go to the oil balance and request this A View into the Future report, and I'll see what I can send you there. Maybe get some further insights on what's going to happen for the rest of the year, at least in the tariff scenario that we laid out in this document. So it's a pretty good report, 13 pages worth of information. I cover all the major products on the oil side. So that's all I've got for this week. Appreciate you watching all the way to the end. Please hit like, please become a subscriber, and please go visit theoilbalance.com for more information. Thank you.